how much is my business worth? And then on the other hand, the buyer is going to be like, how much is the business worth I'm about to buy, right?
We built that tiny little business into about $4.5 million, which in Canada is probably the US equivalent to about $45 million. Your focus has to be on the income or the profit that it generates. The multiple has to make sense from an investment standpoint. The beauty of buying a business is because of the multiple factor, every dollar of value that you add to the business, when the time comes to sell, you're going to get a multiple of that to actually increase the purchase
Welcome,
price.
Richard. Thank you for taking the time. I'm very glad to have you here. For everyone who doesn't know Richard yet, he's an amazing expert in the merger and acquisition fields with 3 decades of experience. Has been featured on a couple of great magazines like Entrepreneur Magazine, and is an author himself as well, teaching people how to buy a business and how to do various things in the merger and acquisition field. But without saying too much, maybe say a couple of sentences about yourself.
Hi, DJ. It's good to be here. I appreciate it. So, like you said, I've been in the world of mergers and acquisitions for over 30 years on all sides. I've bought 14 of my own companies, including one co-investment and a full range of deals from like $50,000 to over 200 million. I've done buy side and sell side representation, and of course my own investments separate and apart. So and teaching people how to buy businesses. So this has been my world for the last 3+ decades.
Awesome. Nah, I love that. I love that. And I love as well the topic we're going to pick today, because I think you're a great person to speak about that, which is actually how much is my business worth? So like every seller, some point, thinking about selling is going to be like, okay, how much is my business worth? And then on the other hand, the buyer is going to be like, how much is the business worth I'm about to buy, right?
Yes.
So yeah, maybe let's jump into that. I think you
Sure.
mentioned 14 transactions you've done yourself. So
Yeah.
what was your favorite one of that, and how did you go about the valuation?
So I was it was early on in my career, and I was in the consumer product business selling to retailers, and I was looking to grow my business and realize that growth through acquisition is going to be a whole lot quicker than organic growth, no matter how interesting or exciting or sexy organic growth is. But it was just apparent to me it become a little too difficult. So I approached a company that was in an ancillary business. They were actually providing in-store servicing to retailers, the same retailers that I was selling my product to. For example, if you think about if you go to some of the warehouse clubs when they're giving you food demonstrations, that type of stuff, it was similar in concept to that. This company would clean up the shelves and bring any stuff from the back room onto the floor. And so it fit perfectly with what I was doing, because very often the merchandise I was selling into stores wasn't getting put onto the floors in time. And so I wanted to acquire this business. I really didn't have the money. I couldn't afford to acquire it for what it was worth, but I agreed. I worked out with the owner of the business, because I had a much bigger vision for what this business could ultimately become, and I worked out a transaction with the owner of the business to give him a small amount of money and bring him into the fold, put his business into my business, and gave him a piece of what would potentially be a larger business. And we ended up starting to acquire a bunch of other companies like that across Canada. I was in Canada at the time, and we built that tiny little business into about $4.5 million, which in Canada is probably the US equivalent to about $45 million, and incredibly profitable. And so that was one where it was really came down to the terms. The valuation was one thing, but it was the terms that were all important to get the deal done.
Awesome. Nah, I love that. I love that. That's cool. But maybe dive a little bit more into how you did the valuation. What type of different opportunities are there in terms of valuating a company? Like what methods are there?
Okay, so it's a great question, because there are multiple methods, and there's clearly a gap between what if you were to go to an accountant and have them value a business, or a professional business value appraiser, because very often they're taking assets and putting a lot more value on the assets of the business. But the reality is, if you're an individual and a budding entrepreneur, and you want to acquire an operating business, your focus has to be on the income or the profit that it generates, because that's what you need to live on. And so the focus, I'm a firm believer that you do your valuation based on the what I call the owner benefit. Sometimes it's referred to seller's discretionary earnings or adjusted EBITDA, but it's basically the number that a new owner will have for themselves to service any debt, pay themselves a salary, and have to be able to reinvest in the business. And so, because the concept is you're going in to replace the existing owner. So that's why it's used in the terms, again, seller's discretionary earnings or adjusted EBITDA, or I like to call them owner benefits. And then there's a multiple that's attached to those. Now, that's a highly discretionary number, because people say, well, is it worth 2 times or 9 times, or what times that multiple? But the multiple, the multiple has to make sense from an investment standpoint. Meaning, if you had $1 million to invest, you have a couple of options. You can put it into a savings account and get 0.5% interest, or a certificate of deposit, or you can go to Las Vegas and put it all on 17 black and get 35 to 1 odds. So, like, that's the range, right? And then
Yeah.
if you were to take that same amount of money and put it into the stock market, over time, traditionally, the stock market returns 11%. And 11%, keeping in mind that that's a very liquid investment. Buying a business is an illiquid investment. It's not easy to just sell the business. And so your return on your investment has to be somewhere between that 11% and that Las Vegas number. Meaning, because you're also going to be working. And so you have to weigh that into account versus putting into the stock market and you're not working. So you have to have a return on your investment based that fits into those parameters. And so, for example, if you were to buy a business for all cash, which I would never recommend, and you were to pay a 5 times multiple, means you would be getting 20% return on your money. Well, you look at that and say, okay, well, that makes a lot of sense, because that's close to double what I would make in the stock market, and that becomes more meaningful. If you start paying multiples that are higher than that, you start infringing upon the return that you can get for a much safer investment. Yes, so it's got to fit within those parameters. The other thing is, on the flip side of the equation, is the beauty of buying a business is because of the multiple factor. Every dollar of value that you add to the business, when the time comes to sell, you're going to get a multiple of that. So if you do in fact buy a business at a 4 or 5 times multiple, every dollar that you add of value to the business, you're going to get $4.50 back when the time comes to sell. So you have to weigh all of those things into the equation. But again, it must fit within parameters of acceptable returns.
No, I love that. Um, One question I would have about the parameters, because obviously the size of the business is playing like a very important role in
Yes.
evaluating and giving a multiple for the business. So, like, how important is the size, and like, what are typical sizes like getting in terms of multiples? So, like, let's say we have like a seller discretionary earning of maybe 200,000 per year versus like a $10 million EBITDA. So how different is going to be how different is the multiple going to be for those two types of businesses?
It's a great question. So there are, let's say, not hard rules per se, but here's how I like to look at it, because you do have those businesses on Main Street or whatever making 200,000 versus an entity throwing off $10 million of EBITDA. So in rough terms, I break it off at 500,000, a million, and a million plus. So under $500,000, generally, you're talking about multiples of 1 to 3 times. And someone says, well, 1 times multiple, that's really low. But keep in mind, at that level, and especially when you talk about a $200,000 business throwing off $200,000, those are very owner-centric businesses usually. The owner is usually the business. The assets of the business are between the ears of the owner. And so there's a much higher risk for someone who's coming in to potentially take over that business to make sure it can continue, because you've got to replace the owner. Exactly. So I like to look at it to just give people some general or broad terms as follows: $500,000 or less. And this is not revenue. This is, like you said, seller's discretionary earnings is usually 1 to 3 times. 500,000 to a million is around 2 to 4, and a million plus is 3 to 5. Now, when you get into much larger business, 5, 10, 8, $1 million plus, those multiples could shift, but they still have to make sense financially on your return. Even though it's throwing off $10 million, doesn't mean you're going to sell it at 15 times multiple. I mean, that's craziness. Except in some industries get impacted that way. But even at the larger numbers, investors have to get an adequate return on their investment. But at the
100%.
lower market, that's, that 500,000, 1 million, and a million plus gives people a really good parameter. I have a valuation program that I developed that we've stress tested on 1,017 businesses. You take all the numbers, because there's more than just the numbers, right? You take the numbers and then you have to look at the fundamentals of the business. Is there any customer concentration? Are the books and records in good shape? Or what are the barriers to entry? Is there a competitive edge to the business? Any key employees? What type of terms are you getting in the deal? So we have 50 fundamentals that we've identified that are critical to the actual operations of the business, past and future, and we score those and then attach that to the number and come up with a multiple.
I love that. It sounds very complex. 50 parameters you're going to look at, but you need to do that because it's an important decision to
Yeah.
take. Uh, Maybe just for the listeners to give them like a small nugget. What would be like out of those 50 parameters you look at? What would maybe be like three you would recommend someone who's just starting or just want to get like a rough number in terms of what his own business is worth?
I think that people should look at the dangerous numbers, meaning are there things in the business that could significantly impact the business? For example, customer concentration. It's prevalent in smaller businesses, and by that, or supplier concentration, meaning a disproportionate amount of the revenue comes from too few customers, or you're distributing, for example, a product line, and that particular manufacturer's product represents 80% of your business. That's dangerous. So that could significantly reduce the valuation of the business. Similarly, key employees or licenses that are held within the business. If there's certain key employees that the business is highly reliant upon, well, you have to give pause to that, because the goal of going into your own business, you want to start controlling your own destiny. So you don't want to buy a business where all of a sudden two of the employees, if they leave, your whole business changes. So
Yeah.
there's that piece. And then clearly the conditions of the financials. Are the books and records in good shape? Is it all reported income? Can you do a proper tracing of all the numbers? Those are three, high level items. And similarly, I would add a fourth, which is the financing of the deal, how much you're able to leverage. Because I'm very much of the ilk of, when I find a business that makes sense for me and it's a good business and it's right for my skill set, I pay less attention to the purchase price. I don't pay any attention to the asking price, but I say, it's very often it's like, I'll pay your price, you take my terms, because the value is in the terms.
Let's do the transition there. I love that part. Yeah, I think you already mentioned it at the beginning with your first deal. So what's maybe even more important than the valuation when you look at the terms? Like what things to look at in terms of risk. Let's dive a little bit deeper on that. What the terms actually look like and why it's more important than the valuation.
Sure. So there's a couple of things right off the top, which are, number one is the leverage. How much can you leverage related to funding, whether it comes from a traditional source like a bank or seller financing? I'm a huge believer in seller financing. I've been teaching and preaching this for decades. 91% of our clients get a component of seller financing for a number of reasons. Number one, you have a lot more leverage or wiggle room in the terms with a seller as far as interest rates, as far as the length of the note is concerned. If the business runs into any difficulty, you could always go back to the seller and get a holiday from the payments for a while. So that's versus a bank, they'll just lock your business up. The other thing is, to me, the only way that the seller can truly validate everything that they've told you about the business is if they have skin in the game as well. It's great for them to tell you all these things in representation, but it really, they put their money where their mouth is when they're providing some of the financing. So that's clearly part of it. Then some of the terms as it relates to, for example, when you acquire the business, especially if you have seller financing, you may be able to negotiate, and you should try to negotiate a holiday from any payments for probably a year, or maybe just make interest only payments for a year. So it doesn't choke you. You get the business, you have some, the excess cash flow allows you to provide some working capital, gives you some room to breathe. You're not concerned. You want to make sure you go into the business and you have adequate cash flow to be able to operate the business. But it just gives you a little bit more wiggle room. So, and interest rates, you can always negotiate lower interest rates with a seller than you can with a bank.
Awesome.
So that's on the seller financing.
Yeah.
And then some of the deal terms, the other ones secondary to the financing would be what actual terms, for example, you have the purchase price, but if there's any element of customer concentration or concerns that you have for the business, negotiate earnouts or performance clauses so that the seller gets their money only if certain things happen. If the clients remain for X period of time or the business grows at a certain rate, those type of things.
I love that. Yeah. What would you say is more attacking more the part of risk diversification, like seller financing or earnouts in terms of the agreement?
Well, I think they're both very important, and I don't mean to answer that like a politician. I think they're both very important. The the nature of the business itself will dictate whether or not a performance component is realistic. You know, if you're buying a business that's growing, it's got great books and records, it's can transition well to a new owner, staff is in place, there's no major concerns, red flags, or etc. Well, if I'm the seller of that business, why would I agree to a performance clause with a complete stranger? My business is good. It's solid. I'm turning over a business to you that as long as you do what I do and continue to do that based on what you're getting, this is a rock solid good business. I don't need to have I don't need to offer you an earnout or performance guarantee because I'm turning over a good business. That's from a seller's perspective. From a buyer's perspective, if those things aren't in place, then you absolutely need to have a performance clause or earnouts. For example, if the business has gone through a recent decline or there's certain things on the horizon that could dramatically increase the business that the seller has put into place but hasn't realized yet, well, you may give them some additional incentive to actually increase the purchase price if certain things happen. So it's not just on the downside. Sometimes it's for incentive to actually give the seller an opportunity to earn even more.
Nice. Yeah, I like that. And it's fair, right? So, like, if the seller already
Yes,
put something in place, but hasn't seen the fruits yet, give him a perspective of earning more in the future by selling the business to
it,
you. Nice.
it's exactly it. Correct.
I love that. I love that. Now that's great. I love your knowledge. I think you could answer all the questions, and I think we could dive a lot more deeper on that. But maybe to give some technical points in terms of like when someone actually wants to craft those terms, what would you recommend them? Get to talk to a lawyer, get to talk to an M&A advisor. Like, what would be the next best person to talk to, and maybe highlight what you're offering in terms of a service as well.
Okay, sure. I'm happy to. Your lawyer plays a role in these transactions, there's no doubt. My take on the attorneys is the attorney should be a scribe. They play two significant roles. Number one, a scribe, which means they transpose into legalese what you and the seller have agreed to. That's number one. Number two, they're going to protect you, do their best to protect you and explain to you what your potential risks are and have clauses or conditions in a contract to make sure that you're adequately protected. You can't eliminate 100% of the risk. If you're looking to buy businesses and to do this 100% risk free, then you're better off to stay as an employee. There's always going to be an element of risk. It's unavoidable. Anybody who tells you difference full of crap. So, but as far as crafting the terms, yes, you definitely, and especially if you haven't done this before, and I see this over and over again where well-intentioned individuals that they're looking to acquire a business, they go down the wrong, they go down the rabbit hole thinking that they're going to negotiate terms that are unrealistic. So you clearly want to educate yourself to understand what are reasonable, what are fair, and what are important to you as a buyer. An M&A advisor, whether that be in someone who's you don't necessarily, as on the buy side, if the broker hasn't brought you a deal, you don't need to hire a broker. They don't represent you. But getting an advisor in place, a mentor, someone that could really help you look at this deal from a point of experience. I'm a big believer in working. You always want to work with people. If you have a problem or a challenge or a project, you always want to align yourself with people who are already at where you want to be. Right? I mean, it's like the age-old way to success. And so advisors, yes, I'm a huge proponent to that. We do a lot of advisory work as part of the program that we offer. And irrespective of who you hire or what you do, you've got to get someone, especially if you're not if this is new to you. I mean, if not, you're going to end up making a mistake. It's almost unavoidable. But the lawyer plays the role pretty much after you and the seller have fundamentally agreed to the main components of the deal.
Okay, no, I love that. And how can get people in touch with you? Like, what is the best way to reach you and get advice from you personally?
The easiest way is go to our website, which is richardparker.com. Built this whole website as an education, almost as an educational portal for prospective business buyers, where we have articles, videos, free reports, and people could really get educated. Because if you're going to consider buying a business, especially if you haven't done so before. I don't care what degree you have from what university, you have to face the fact that you know absolutely nothing related to buying a business. So you've got to educate yourself.
Yeah.
And so that's the first thing. And we have a course that we've sold, it's sold into 80 countries. We've sold 100,000 copies plus.
Nice.
It's a course that walks people through the whole step by step through the business buying process. And as part of that, you're able to email me anytime with any questions that you have, and we never charge people. When people are in the throes of the deal, I'm happy to get on a phone call. As a matter of fact, after this podcast, I have a client who's based in Maryland, and she's looking at a transaction right now and rating up an offer, so we're going to spend half an hour on the phone, just go through the details. So that's richardparker.com is the best way, and I'm happy to help anybody.
Awesome. I love that. And thanks a lot for taking the time. For everyone who's listening, reach out to Richard. He's an expert. He's amazing in doing what he does. And subscribe to our channel as well. Short introduction there. But yeah, thanks again for having you. It has been great. And thanks for answering all the questions.
My pleasure, DJ. I really enjoyed our time together. Thanks again for having me.
Awesome. Awesome.